Hello, property navigators. Australia's property super cycle is said to lead to a fundamental reshaping of Australia's housing landscape. But have you seen all the drama about it? The ads, masterclasses and articles. What about this one?
This is Australia's last property boom of the 2020s.
Don't get caught up in their fear campaigns. Today I'll explain exactly what this super cycle dialogue means, why there's an argument it'll happen here in Australia, and how our market got to this point in the first place. All of this is important to understand because you'll also get some solid tips like where to look and what specific assets to look for so you can figure out how you might take advantage of any opportunities. Let's go. What is this super cycle? Firstly, it's a pretty catchy term, but this property super cycle that everyone's on about is not going to be about jaw-dropping double-digit booms every year and everywhere. That's nonsense, and I want to be clear. It's not a hotspot-like boom, nor will it have the characteristics of it. Instead, it will likely be a period of prolonged, more consistent, but still significant price growth. Why? Because of serious and deep structural shifts, not just in the property market, but in Australia. Now, factors such as sharp population growth that has also resulted in changing demographics, persistent housing supply shortages that have also caused rental crisis, the underlying wealth Aussies have accumulated, our country's economic and employment stability, improved sentiment and confidence, and the evolving living preferences of our Aussies. When all these come together and combine, they create a whole that is so much greater and more powerful than the sum of all the individual parts. This is what forms the backbone of the super cycle argument, and shortly I'll drill down into these factors and explain all the hows and whys. But the key point here is that a long runway of steady, prolonged upward growth over years is projected, unlike quick, sharp, short-term spikes that characterize hotspots or booms that then fizzle out or bust. To understand this, let's quickly run through what a typical or standard property cycle looks like. There are 4 distinct periods, including the upturn, where prices start to pivot upwards, the boom period, where prices shoot, the downturn, where prices peak and then might come down, and then stabilization, where prices level out for a fair period. Then it all starts again. Here's our national property cycles, where you can clearly see the 4 distinct periods in each cycle, up and down. That's what the property market does. The point here is that the super cycle argument is referring to a sustained period of significant and prolonged price growth, which might be in the form of a much longer cycle with a more sustained upturn and boom period, or multiple short cycles that are stacked, meaning that they are timed much closer together, then they start once again at a sooner rate due to having a much shorter downturn and stabilization periods. That's why it's being called a super cycle, as dramatic as that may seem. And this has already been evidenced, with CoreLogic describing the latest property market cycle as having a short and really shallow downturn that lasted just 3 months. We have 9 short topics to cover here to understand the hows and whys, starting with our population boom. One of Australia's property market secret weapons is population growth. Simply put, more people means more housing demand. The latest ABS data shows Australia's population hit around 26.9 million by late 2023. That's an increase of nearly 500,000 people in just a year, largely through immigration. Annual net overseas migration reached roughly 564,500 by the September quarter of 2023, an all-time high. That's like adding a city bigger than Canberra in 1 year purely from immigration. Every one of those people needed a place to live, whether they rented or bought, which put immediate pressure on our housing market. Now, immigration can ebb and flow, but in the long term, Australia is committed to population growth because our economic growth and workforce both depend on it. The ABS projects we'll add around 3.7 to 4.6 million people by 2033, meaning we could be a nation of over 30 million. That's like adding another Sydney's worth of population in that short time. The ABS explicitly noted that strong population growth has supported demand for housing while our housing supply remained constrained, which brings us to the topic of the supply crunch and rental crisis. Despite hugely increasing demand over the past decade or two, housing supply in Australia has been shithouse and has not met our needs. It's not a new problem. You can see how long this has been going on. But it's now that we're feeling it. Why? Construction costs have skyrocketed with materials and labour being pricier, and we've seen building companies go bust, which halts projects completely. There's also the issue of new building regulations known as green and red tape, adding up to $50,000 in extra costs per new home. We also have a construction workforce shortage. The government says it granted 10,500 visas to tradies in the previous financial year, but that hasn't translated to more dwellings being built. Many of those workers are building on renewables and other projects, not houses for Aussies. Higher costs, tighter margin, and a limited workforce means fewer developments get off the ground, meaning new supply has not kept pace with the population surge. Now, on top of that, many existing homeowners have been reluctant to sell in the recent climate. Most sellers are what we call discretionary vendors. They'll only list their property if conditions are favourable for them to achieve their desired asking prices, unlike those who must sell to financial stress or life events. With interest rates rising through 2022 and 23, buyer sentiment was really shaky, so many would-be sellers decided to hunker down and wait. In fact, the CBA's home buying index, which is a measure of home buying intent, fell by about 2/3 from its peak and has been about 40% below pre-COVID levels. Homeowners who considered selling during this time also had to consider finding a new property to live in afterwards, which was also a bit sketchy. So, a lot of people just stayed put. This created a listing shortage. Very low numbers of properties available for sale, especially in desirable suburbs. Ironically, that low stock itself helped underpin property prices. It's a classic supply and demand squeeze, and nowhere is this squeeze more painfully felt than in the rental market. There's a crisis, and the data absolutely backs this up. From 2020 to mid-2024, rents in some cities are up around 30 to 40% cumulative, a huge jump in just a few years. What's driving it is vacancy rates, essentially the percentage of rental properties that are vacant and available. Australia's rental vacancy rate hit a record low of around 1% in early 2023 and 24. To put that in context, a balanced rental market might have around 2 to 3% vacancies. We were at 1% or below in some of our cities. Effectively, nothing was available. It's reported as the tightest rental market on record. How do we end up here? It circles back to that chronic undersupply of housing. AMP's chief economist estimates Australia has a housing shortfall of at least 200,000 dwellings, but others estimate it's more like 300,000 more homes we require right now to meet our population's needs. New building approvals are running horrendously below the levels needed, so this shortfall isn't closing anytime soon, if ever, with the way it's been progressing so far. This massive shortage is a key reason why home prices have remained so resilient. There's simply more demand than supply, so competition stays high. And until we add significantly more housing stock, it's going to remain a landlord's market, which is great for investors. The next really important piece to consider is Australia's economic climate: interest rates, sentiment, employment, and household wealth. These next 6 influences show the ability of Aussies to fuel this super cycle with even more demand, basically fueling the fire. The Reserve Bank's aggressive rate hikes aimed at taming inflation were a major source of volatility. Rapidly rising mortgage rates slashed borrowing capacity, and buyer confidence took a major hit. However, now in 2025, there's a sense that the worst is over. Inflation has been coming down, and the RBA delivered the first interest rate cut in over 4 years. Just the anticipation of this pivot was enough to shift the mood in the housing market. We saw the Westpac Melbourne Institute Consumer Sentiment Index jump 4% in March 2025, hitting its highest level in 3 years once that February 2025 cut happened. Now, it's still below the 100 mark, which means overall pessimists slightly outweigh optimists, but it's a remarkable turnaround. Buyers are feeling more optimistic that interest rates will continue to move lower over time, or at least that we have some stability, which helps with their planning. With this higher clarity, buyers and sellers can make decisions with more confidence. We've seen auction clearance rates and attendance improve as this sentiment has turned around. It's a good reminder, psychology matters in real estate. When people fear things will get worse, like interest rates climbing without an end in sight, they retreat. When they see light at the end of a tunnel, they become confident and re-engage. It's a clear pattern of consumer behaviour. Now, while all this has been happening, the broader economy and employment have been surprisingly solid. Unemployment did rise slightly from its 50-year low of around 3.5%, but it's been holding at roughly 4% through late 2024 and early 25. In other words, the vast majority of those who want a job have one. Naturally, this allows people to be able to buy homes, upgrade, or invest. Our strong labour market has been key and has cushioned our housing market. Because most people kept their jobs, property owners were generally able to keep up with their mortgages as rates went up, and we didn't see a major spike in defaults or forced sales. In fact, the banking data shows mortgage arrears stayed around pre-pandemic levels as rates increased. As of late 2024, mortgage arrears were under 1%, which is low by historical standards, showing that widespread default remains unlikely. One critical factor is that very few property owners are in negative equity. Thanks to the huge recent price gains, most owners have a healthy equity buffer. Even those who bought at the peak and saw a small dip likely recovered much of that value by now. It also means banks aren't panicking about bad loans on their books, so we haven't had a credit crunch, meaning lending is still flowing. During the pandemic, Australians amassed large savings and many paid down loans or built up offset account balances. So when rates rose, a lot of mortgage holders had a head start and were ahead on repayments or had a buffer. The rising property values pushed household wealth to record highs. We ranked number 2 in the world for wealth per capita, with many older Australians now mortgage-free and keen to right size, invest or assist their children to buy property via the bank of mum and dad. By the end of 2024, total household wealth hit about $17 trillion, up 6.6% from the year prior. Let that sink in. It's massive, and we're a world leader on this. To put that into a relatable frame, our household wealth is nearly 11 times our annual disposable incomes. Much of this wealth is tied up in housing. Roughly 70% of household assets are in property and land. This means property owners collectively have trillions in equity. So when we pull these 6 influences together, we have lowering interest rates making borrowing money cheaper, which raises the amount of money people can loan. 2, reignited buyer sentiment and confidence, meaning people are willing and want to buy. 3, high employment, so more people have the ability to borrow and service debt. And 4, huge amounts of household equity and wealth that many Aussies can tap into and leverage against to buy more property. This is a very powerful mix and puts more Aussies than ever in a position to purchase property, which ultimately drives demand even higher. Now I'll segue here to the final demand driver we'll cover today, policy shifts. Right now, housing affordability is at one of the worst points on record, with the median dwelling price being around 8 times the median household income. For context, a few decades ago, that multiple was more like 3 to 5 times. As I just covered, existing property owners are asset rich and in a great position to invest. But aspiring first-time buyers are finding it extremely challenging to get into the market. Primarily speaking, this is where the government is stepping in to provide first home buyers assistance to help them get into the market, which is a great thing because they need it more now than ever. But by providing this through whatever policies that may be, first home buyer grants, 5% deposit schemes, allowing super to be used as a deposit, or whatever future policy our government rolls out, it will only drive prices up further because, you guessed it, it drives demand by easing the barriers to get into the market. We have massively increased demand driven by our population surging. Layered on top of that is our economic and wealth climate, which positions a ton of Aussies with the ability to buy, and it's being suggested that they will. Layered on top of that, we have lots of first-time buyers that will very well be able to enter the market with policy shifts. Now, these factors are adding pressure to an already depleted Australian housing supply. We are already in a shortage. Added to this, we are not building anywhere close to the supply of new builds required to feed the future demands of our population, let alone our current. It's an absolute cluster. When all these powers combine, enter the super cycle. Not everywhere will experience the same growth. Australia has over 15,000 markets and each will experience its own growth trajectory, just like during any regular market cycle. A super cycle isn't any different in that regard. You want to find the right markets and the right assets within those markets that will outperform others. But remember, it's not only where, but when you buy. And we have tons of videos here on our channel to help you with this. Start with a macro view by selecting the right state by comparing the timing of their market cycles, then zoom in to a meso view of analysis using key criteria such as population growth. An area that attracts more residents is a positive sign. Employment growth. Local job creation fuels demand, not just the percentage of employed residents. Real wages growth. Higher real local incomes support rising house prices and tenants' ability to pay higher rents. Tight supply. Less than 3 months of sales stock continuously on market means demand is high. Demographic mix. A balance of young buyers, upgraders, and downsizers sustains long-term growth. Gentrification, the demographic of those moving into the area. Education, proximity to desirable schools. When regions and suburbs have been identified, then look at the mix of housing stock. Find areas with the missing middle asset class, duplexes, triplexes, townhouses, and small apartment complexes that sit in between the size and desirability of a house and a unit. We know that the future of affordability in Australia hinges on attaining higher density living. But that doesn't just mean people living in high-rise apartments. The middle asset class is where many Australians are shifting their preferences to. This is especially forecasted into the future as our demographics change and evolve. There is growing demand for families that want a house and all the amenities that a house provides, but they're happy to sacrifice the yard space in able to afford that, especially if they can easily access their amenities close by. Think of the 20-minute neighbourhood where everything's in convenient reach. So the final piece of the puzzle is to zoom your analysis in even further down to the micro level, being your asset selection. Houses will be the winner over apartments in the long term. Standalone houses on decent sized blocks of land will become scarcer and therefore attract a premium, particularly those that have the scope to be rezoned, subdivided, or amalgamated with other blocks for redevelopment into that missing middle asset class. We see this type of development being encouraged by many local and state governments in their rezoning, meaning investment potential is really high in the long term for assets with higher house to land ratios. Remember, the golden ticket is the right combination of the micro, meso, and micro analysis data points I've explained today. Then remember to perform thorough due diligence on that asset. And we have a whole checklist you can download for free for that. Our team analyses Australia's national property data every day, and we combine this with research such as this and our on-the-ground knowledge. If you're looking to buy and want some help, I'm happy to run you through how we do this. Just give me a call or jump onto our website and book a free discovery call with Boyd and myself. Until next time, happy property navigating.